Morning all. This is a brief introduction before I get started. My name is Chris Burke. I'm an Assistant Director in Deloitte's Modelling Centre of Excellence, and I have been the lead modeller on 3 or 4 of the large urban regeneration projects happening in the UK at the minute. This morning, we'll be taking you through Financial Modelling 101 on development appraisals. So the content for today's presentation is a brief explanation of financial modelling in real estate. We'll go through how to lay out a simple development appraisal model using best practice. I'll also cover commonly used formula and functions, and don't worry about following along with these. There is an appendix at the back of the presentation, which I believe you'll receive, which explains how to use them. And you'll also see on each slide where I have used formula, those formula are written out underneath, so you can see examples. I'll also take you through best practice in terms of error checking and validating models, and then we've got some time for any Q&A. Should say this, I understand I've got 40 minutes to go through this, so it might be quite quick, but the slides have been written in such a way that you can pick them up and follow them after the session, so don't worry if you don't quite follow along in real time. So we'll get started. Fundamental principles of financial modelling. It's important to plan before you develop. Key things when planning a model is firstly the objective and use. So what is the model for? Who will use it and how will they use it? So common examples would be for you guys as public sector bodies, you tend to be the people who own the land and will be thinking about selling it. So what is my land worth? Under a given set of scenarios, this will be a different model to, say, a developer who is trying to understand their financing requirements as they go through a project and whether or not they can fund it. Planning and design sounds obvious, but isn't always forefront of people's minds. You need to really focus on agreeing the outputs, what your cash flow statement will look like, or your financial statements. What are your key assumptions, what information you've got, and then how that will drive your calculations. It's key things to think about up front. And then throughout your development phase, there's 5 key rules that we try and follow. Simplicity, so make sure that whoever's reviewing your model can follow it along. Flexibility, commonly through projects, values will change, inflation assumptions will move, that sort of thing. The model needs to be able to deal with changes as you go. Clarity is what it says. Consistency, which I'll get to slightly later. And then robustness, which is around error checks. In real estate modelling specifically, my work typically answers at least one of these 3 questions. How much is a piece of land worth? Tend to be from your perspective. How much financing does a project require? And then quite commonly, when will my houses be delivered and occupied? Which will drive things like council tax receipts and how many of these houses will be affordable. Typically, to answer a question on how much is a piece of land worth, we use a development appraisal technique. So for those not familiar with the development appraisal, I list out here the core components. This is a simplified approach. I haven't included things like infrastructure costs or demolition and things like that. So we're assuming you're taking a piece of land that's ready to go. You'll have residential income, which is typically calculated on a £1 per square foot value, NIA. Commercial income, which is typically your offices or retail premises, commercial buildings that will be sold off to a landlord who look to set value on a yield basis. You'll then have land costs, which the purpose of the model is calculated. Construction costs, again, built up on a £1 per square foot value. Construction contingencies, professional fees, statutory payments such as your sills, section 106s, etc. And then selling and letting costs. And then You'll also have a financing rate, which will vary by commercial terms. So this would be the layout of our cash flow statement, as I explained before. So best practice approach to structuring your model. So what we tend to find is helpful is to separate your inputs from your calculations from your outputs. It makes it easier for a user to locate all inputs in the model. It helps ensure that each input can only be changed once. It makes it easier when performing sensitivities. So you see here we have capacity inputs. This tends to be what's being built, the actual buildings themselves, how big they are. So gross internal areas, net internal areas, number of floors, sort of thing. Driver inputs, which will be things like build costs and sales values. And then general inputs, which will be around timings, but will also include things like cost profiles and cost curves. Calculations are what they say on the tin. And then your output statement, so cash flow, as I said before, and then dashboards, which I'll get to slightly later. And then we also find it's helpful to have a content sheet and some checks, which again, I'll get to later on. So best practice in structuring your inputs. I typically follow the logical sequence of events. So in this case, what are we building? When are we building it? And how much do we sell it for? You can equally start and work your way down a cash flow statement, but this makes more sense to me personally. So you'll see within this lovely laptop on my screen, we have an example of an input sheet for capacity inputs. So here I've got your list of buildings, which is an input, gross internal area, efficiency rate. So how does that gross internal area convert to a net internal area? And the difference there, for those who don't know, is things like staircases or lobbies, which won't get rented out, or sold, which won't generate value for you. You build gross internal area, you sell net internal area. The number of units, which will drive when they get sold, and then an average unit size, if you calculate. And then to the right, we have a couple of error checks, which I'll come back to in a minute. Similarly, I then work through my construction costs as a separate input, and you'll see that I link the buildings from the original capacity inputs, which then means if I update it, I only update it in one place. Similarly, gross internal area links through, then have build costs as an input, as a rate, which calculates me a build cost, contingencies, professional fees, and then I have a construction start date and duration, which I then use to calculate a construction end. And this is important in terms of flexibility later when I get to calculations. Similarly, for sales, you'll see I do the same thing again. I link through my list of buildings from my capacity sheet, same for my net internal area, and then I have my sales rate inputs, which drives my sales value, have my unit inputs, which I link through as well, which drives my average unit price, sales agents fees, which is typically a percentage, and then I have sales rate. Typically, we model that you would sell X number of units per month until everything sells through. And then sales period, start dates and durations again. And then similarly for commercial buildings, we've got the same sort of approach, but with the key inputs there being rental value, yield, which creates a cap value, letting agents fees and sales fees. And then a letting start date, which I've calculated for the simplicity of this model as one day after the construction end period. One other key input we find useful is S-curves or cost profiles. Typically, your cost consultant will give you a construction cost curve. So over as the example here, 6-month construction period, you would build 7%, you would incur 7% of the costs in month 1, 16.88 in month 2, and so on and so on and so forth until it's completed in month 6. And these tables are helpful to use model flexibility. So if I just flip back a slide to, this slide, you'll see that my construction periods are durations, which means that I can then index here for the appropriate curve and then index here for the number of periods through the construction period. You'll also notice these lovely little grey cells that we use on the side. These are what's called rubber bands. It's helpful when setting up your index to use these spare spaces in case you need to add rows or columns and expand your table later. Your index will then carry on working. So that's input sheet. Then as we get through calculations, we recommend taking a consistent approach. What I mean by that is developing one timeline that you use for all calculation sheets so that things are always in the same place. You see here, 2019 is always column C, 2022 is always column F. And then similarly, using consistent formula blocks. So having a unique formula here in your first range, and then this continuing the whole way across. This makes it much easier for reviewing and avoiding errors. Right. Next best practice tip here is breaking calculations down to make them easier to follow. It's good practice and it helps you include error checks. You'll see here, building on the previous slide, I have all of my section headings in column F. I then have all of my descriptions in G, a unit in H, have my inputs clearly in a section here, inside this red box. I use a row total, column Y, always column Y. And then I have my main calculations from AA onwards across the timeline. And you'll see in all slides, these are consistent. I use. So we say breaking this down, what this is showing you here is a build-up of calculations for residential build costs. So we use flags. So in this case, I have a construction start date flag. I just use an if statement to see if my date in row 2 is equal to my construction start period. If it is, return the 1, if not 0. I have a construction period flag, or counter, sorry, which counts out which position I'm at in the construction period. I then have a profile, which links back to the cost profile curve I just showed a demonstration of. This uses an index formula to find an appropriate row in the table. So this is a 12-month long build. So it'll take the 12th row of a table. And then it'll take, in this case, the first month be 2.16, the second month would be 5.11% of the costs, so on and so forth. Then break out my construction costs. So I had an overall input of £3 million. That gets multiplied by the profile, giving me the right amount of cost in each period. And then I have a contingency rate, which applies over the top. Benefits to doing this and following this approach is obviously it's a dynamic. If my construction profile changed, or my construction period changed, the only input I would need to change would be the duration, and everything else would update automatically. Similarly, if I needed to delay the construction start by, let's say, 6 months because of delays, I could just update that date and everything else would move accordingly back in the input sheet. So once you've calculated your build costs, you'll then want to calculate your residential income. So as on the previous sheet, I follow exactly the same layout in terms of where things are. I use a sales period flag, which tells me if I'm between the two dates when I expect to be selling things. I then use my sales rate input, which determines how many of the properties I think I'll sell in a period. And you'll notice here I use a formula that maxes and mins to make sure that I don't try and sell more units than I've got. So if I sell 4 in the first, 4 in the second, and I've only got 10 total units, it will then limit that to 2. I use this sales rate, sales units per month, to then multiply by my sales value to give me my sales income in the period. And then I have agents fees, which are typically set as a percentage of the overall sales price, which are incurred at the period of sale. Calculating commercial income, just working through logically. I said at the start, commercial property is typically sold to investors who are focused on a rental yield. So in this case, I've got an annual rental value of £900,000 and a yield at 6%, which would give me what's known as a capitalised value of 15 million, which is just simply rental over yield. However, we need to consider the purchaser's costs, so things like stamp duty, legal fees, etc., when buying this property, because it's the total amount they spend they want the yield on, which is typically estimated at 6%. We then subtract these costs, and that gives us 14.1 million. You then see I've used a similar approach to before. I calculate my sales period start, or my letting period start, which is my sales period in this case as well. I then calculate my sales value, multiply it by the appropriate period, flag, calculate my purchases costs. That gives me income, and then I calculate my associated fees off these. You'll see again, each formula is given in purple to follow. And I should say as well here, the benefit to laying out horizontally is that I've just shown the example for one property on each of these tabs, but I will do 10 in total. So you could just copy and paste, create rows, copy and paste these formulas down to do 10 blocks, and then do the next 10, next 10, next 10, so on. And your model will calculate correctly. Next thing to calculate, so you'll see here I've now put together the simple cash flow statement. Calculate my financing. It's very common for people to get excited at the outset of a project and try and think in terms of real loans. We tend to advise to keep it simple until you entered commercial conversations with lenders, and just use a revolving credit facility which calculates an overall financing amount required in any period, and then just use a cost of debt or cost of financing input. One thing to note here to avoid circularity, so I calculate my own opening financing position, and then take the overall cash flow in the period, which gives me a final financing period, and I calculate my financing costs. So this is a 5% annual financing rate, which I decompound. I calculate this off the opening position. If I try to calculate it off the opening financing required plus the expenses in the period, the calculation would become circular, which you want to try and avoid. I should say here, if you have any specific questions on financing, please feel free to ask at the end of the session. Next point as we work through would be calculating your land value. This is commonly done with what we call a residual approach, which is essentially once you take into account all income, all costs, financing, and extract the developer's target profit, what's left, and that comes to the landowner. This calculation is inherently circular, as the value of the land impacts the level of financing, which impacts the amount of profit available, which impacts the value of the land. So to avoid this circularity, we commonly use what we call a circularity break. So you'll see here I have a hard-coded value, which is used for calculations of land costs. And what we do is we typically goal seek. So you have a developer's profit target level, which in this case is 20% based on GDV, maybe based on cost, but that's a standard industry metric, is profit on GDV. The model calculates the current profit on GDV. You calculate the difference between the two. You'll notice that I've multiplied this difference by 1,000, and that's just because the goal seek in Excel is quite sensitive. And then use goal seek functionality to set this difference to 0 by changing the land cost input. And then that will calculate through a land value, which in this case is £43,818,000. That's how to perform calculations. We then get to error checking and model validation. So we recommend the use of a master error check throughout all of our models, which is this lovely green box here, which you'll have seen on each of my tabs, which includes in each of my worksheets. And then you have a summary of checks. So this gives the checks from each worksheet, which you then total up into your master check. And then you link the master check to this lovely green box. In each individual worksheet, you'll see that we have worksheet checks. So that's what we have here in cells B5 and C5, which just sum everything in that column below them. And then we have specific checks, which you're seeing in the worksheets. So here's the example, where I include checks at this point, which sum through. So we say it's good practice to try and build through error checks as you're going through your model. Think about what could possibly go wrong and try and trap the problem. In this case here, you'll see on my input sheet, those who were looking at one of the earlier slides, I had an error on the building for Luther Heights. And that is that I have got a gross internal area. Sorry, I've got a net internal area, but I haven't got any units, which would mean that when I came to sell the properties, because I'm trying to sell on a sales rate, there are no units, there'd be no revenue. And we advise thinking through at your early stage where you're creating inputs, what could cause issues with your calculations, and try and trap those errors. Other things that would be helpful here would be using things like minimum and maximum value checks for your average unit size. You may want to use data validation rules for your number of units that would set a minimum of 1 as an example, and a maximum of whatever the most you have is. And similarly for efficiencies, to limit them to be between 0 and 100. The bits that we find very helpful when checking models for errors would be analytical review. The key thing to assist you with analytical review is developing outputs in such a way that allow you to review KPIs. If you were looking at this worksheet here as an example, this gives me a list of the residential properties that have been built. Gives me output of GIAs, NIAs, efficiencies, the units, build costs, etc. And then the sales values per unit. And you may note that one of these units has a particularly low build cost and a particularly low sales value, which is because someone's got a fat finger error here and has entered 50 rather than 5. We recommend having someone familiar with your project, but not the person who's built the model, perform the analytical review. This separation from the build often makes it easier to spot errors hiding in plain sight, such as the one I've just shown. When performing an analytical review, we would recommend you focus on KPIs such as these, any key trends in the cash flows, performing what we call flex testing, which is changing inputs to see the model's response. In which case, if I set my units equal to my NIA, would I see a sales value equal to my sales value input? Would, that sort of thing. And then benchmarking, as in this example here, comparing again to other properties to see how it works. Where your models become more complicated, it may be worth using specialist modeling software, seeking external support.